Hey everyone, and welcome back to the channel. I'm your host, and today we're diving deep into a topic that every crypto enthusiast, investor, or even curious observer needs to understand: the powerful, often unpredictable, and undeniably human sentiments that drive the cryptocurrency market. If you've ever wondered why prices swing wildly, why certain coins pump unexpectedly, or why seemingly solid projects can crash without warning, much of the answer lies in the collective psychology of millions of participants. This isn't just about technical charts or fundamental analysis, it's about fear, greed, hype, trust, and a whole spectrum of human emotions. So, grab a coffee, get comfortable, because over the next few minutes, we're going to unpack the intricate web of sentiments that truly govern the crypto world. Let's start by defining market sentiment. In traditional finance, market sentiment refers to the overall attitude of investors toward a particular security or financial market. It's the general feeling or tone that investors have about the market's prospects. If investors are optimistic, the sentiment is bullish. If they're pessimistic, it's bearish. In cryptocurrency, this concept is amplified to an extreme degree. Why? Because crypto markets operate 24/7, are highly decentralized, lack the same regulatory frameworks as traditional markets, and are often driven by retail investors who are more susceptible to emotional decision making. These factors create an environment where sentiment isn't just a contributing factor. It's often the dominant force. Understanding it isn't about predicting the future with perfect accuracy, but about recognizing the underlying currents that can lead to significant shifts in value, allowing you to make more informed, less reactive decisions. One of the most powerful and widely discussed sentiments in crypto is fear. We often hear the acronym FUD, which stands for fear, uncertainty, and doubt. FUD is a potent force that can trigger massive sell-offs and market crashes. When FUD grips the market, investors, especially those new to crypto or those with less conviction, tend to panic. They see prices dropping, hear negative news, or witness a rapid decline, and their immediate instinct is to protect their capital by selling, often at a loss. Where does FUD come from? It can originate from several sources. Regulatory crackdowns or even the threat of regulation can induce significant fear. Governments worldwide are grappling with how to classify and control cryptocurrencies, and any suggestion of stricter rules, outright bans, or heavy taxation can send shivers down the spine of the market. We've seen this play out multiple times with news from countries like China or discussions within the US Congress. Another major source of FUD is security breaches and hacks. The crypto space, despite its technological advancements, is still vulnerable to malicious actors. When an exchange is hacked, a decentralized finance protocol is exploited, or a major project experiences a security flaw, the trust of the entire ecosystem can be shaken. Investors worry about the safety of their funds, leading to a flight to safety, or more commonly, a rapid divestment from potentially compromised assets. High-profile hacks of exchanges like Mao, Gox in the early days, or more recent DeFi exploits have had ripple effects across the market, illustrating how quickly fear can spread. Beyond these tangible threats, FUD can also be fueled by widespread misinformation or negative media coverage. Traditional financial outlets, often skeptical of crypto, can publish articles highlighting risks, volatility, or the potential for fraud, which can be interpreted by a broad audience as definitive reasons to avoid or exit the market. Even rumors, unfounded claims, or misinterpreted data can quickly propagate through social media channels, leading to rapid changes in sentiment before factual corrections can be made. This amplification of negative news, whether real or perceived, highlights the importance of critically evaluating information sources. On the opposite end of the spectrum, we have greed, and in crypto, greed often manifests as FOMO, or the fear of missing out. FOMO is an incredibly powerful psychological trigger that drives irrational buying behavior. When investors see a particular cryptocurrency's price skyrocketing, especially if it's accompanied by widespread hype and success stories, they become afraid of being left behind. The desire to participate in what looks like easy gains can override rational decision making, leading people to buy assets at inflated prices, often without conducting proper due diligence or understanding the underlying risks. FOMO-driven pumps are a common phenomenon in crypto. A project might gain traction due to a new partnership, a celebrity endorsement, a technological breakthrough, or simply a coordinated effort by a community. As the price starts to rise, more people notice fear missing out on profits and jumping further, pushing the price up. This creates a self-reinforcing cycle until inevitably the buying pressure subsides and early investors take profits, often leaving those who bought at the peak with significant losses. The stories of people turning small investments into fortunes overnight, while captivating, also feed into this cycle of greed, making others believe they too can achieve similar results if they just get in on the next big thing. The allure of rapid wealth accumulation is a core driver of greed in crypto. Unlike traditional assets where gains are often more incremental, the extreme volatility of cryptocurrencies offers the tantalizing prospect of massive returns in short periods. This potential acts as a powerful magnet, drawing in investors who might not fully grasp the risks involved, but are captivated by the dream of financial freedom. The meme coin phenomenon, where assets with little to no fundamental utility gain incredible valuations purely on community hype and speculative buying, is a prime example of greed and FOMO in action. Next, let's consider the role of hype and narrative. The crypto market is incredibly narrative driven. Projects don't just sell technology, they sell a vision, a story, a solution to a perceived problem. Whether it's the narrative of decentralized finance empowering the unbanked, NFTs revolutionizing digital ownership, or Web3 creating a new internet, these narratives capture the imagination and attract capital. A strong narrative can generate significant excitement, drawing in both retail and institutional investors. Hype often surrounds new technological developments, major upgrades, or high-profile launches. For example, the build-up to Ethereum's merge to proof of stake or the launch of a highly anticipated layer 2 scaling solution can create tremendous hype, driving up the prices of associated assets. This hype is fueled by developers, community members, influencers, and media, all contributing to a collective belief in the project's transformative potential. The power of narrative extends beyond technology. It can also involve compelling stories of individual success, community resilience, or even protest against established financial systems. These stories resonate deeply with people, creating a sense of belonging and purpose that goes beyond mere financial investment. When a project can articulate a clear, compelling, and often idealistic vision, it taps into a powerful human desire for meaning and impact, generating loyalty and enthusiasm that can sustain interest even through periods of volatility. Closely related to hype is the influence of social media and influencers. In the crypto space, social media platforms like Twitter, Telegram, Discord, and Reddit are not just communication channels, they are central to market dynamics. Information, rumors, and sentiment spread like wildfire. A single tweet from a prominent figure, a coordinated campaign by a community, or a viral meme can instantly shift sentiment for a particular coin or the entire market. Influencers, ranging from well-respected analysts to controversial personalities, wield significant power. Their endorsements, criticisms, or even subtle suggestions can lead to large price movements as their followers react en masse. Thank you so much for watching this video. I hope you found this video informative. If you are new to the channel, then please make sure you like, subscribe, and share this video as much as possible.